ready?
Welcome to the Lead Clinic Podcast. I'm your host, Dr. Peter Vitale. Today, I'm joined with a very special guest, Otto Foerster from Avante-Nea, an insurance brokerage in Miami, Florida. Otto, welcome to the podcast. Thanks for joining us.
It's great to be here. It's great to be in Vegas. It's always good to see you.
Great to see you as well. And, you know, I was thinking before we started here, you know, we met each other maybe a couple years ago, and that was in Tennessee, in Nashville, right?
That's right,
at the Nash Vegas, and we're shooting this in Las Vegas the week of LeadsCon. So it's good to see you again. And we were at the PACE conference at that time, and we both, you know, share a pretty interesting insurance background. And you know, a lot of the folks who listen and watch this podcast are captive insurance agents. And, you know, I like us because we're real technical, right? And so when I say captive, I'm talking about Allstate agents, State Farm agents, Farmers agents, that kind of captive. So you currently are a partner at an independent agency that is commercial focused, I would say?
Yeah, commercial focused. I mean, we have a good sized personal lines book, but our background in the backdrop of territory in Florida is just a tough market to be in from a property casualty homeowners. We're facing, the United States is facing issues for homeowners, but Florida specifically has their own issues. So there's opportunity for us there because, the premium size is not, typical. It's, $5,000 to $7,000 for a homeowner's policy. So, clients, buyers of insurance really need help navigating that. And as an independent broker, we're kind of trying to mix the marketplace to fit the client's needs, whether it's price or terms or a mix of both. That's a little bit about Florida, but as an independent agent, I think the difference, not the difference, but part of our role with the client is we're sitting on the table side of the client. We're not on the other side of the table with the client. And we're kind of interviewing insurance companies on their behalf and kind of whispering into the client's ear and telling them, hey, we like this carrier because of XYZ. We don't like this carrier, but their price is really good, so don't be tempted by that. But that it takes years to get to that relationship, because when you first step into a client relationship, they kind of sitting there with the sword and the shield in their hand and like, I'm not going to show you anything, and you kind of have to like, hey man, I'm on your team. We're here to work together, and then the marketplace is here to serve us. And we're looking to offload risk from our personal balance sheet or our business balance sheet. We have certain risks that exist, whether they're known or unknown, and we're looking to the insurance marketplace to unload those risks for a price, for a premium, subject to terms and conditions, deductibles, warranty statements, endorsements, exclusions. And our job is to kind of demystify that buying process for the client, for the buyer, and we specialize in the tough to place and the kind of weird, darker markets of insurance, and it's a great business. I mean, insurance is a phenomenal business. That was kind of what we related on a ton was how great the mechanics are of insurance brokerage, and it's just fascinating and super lucky to be in the space.
So what does your average client look like? So like I told you a minute ago, a lot of our listeners might be, personal lines focused captive agents, but what does your average client look like? Not in terms of like business, but like, size, scope, number of employees, type of revenue.
Yeah, I mean, we serve the middle market, and
define that for us, for those who don't know.
So there's all these different alphabet soup in every industry, but when you're talking about the macroeconomics of the United States, there's kind of small business, or now there's a new term, SME, small middle market enterprise, and then but we'll hit those small kind of sub 25 employees, maybe sub 10 million revenue, and we'll grind those out all day. We kind of call those singles. We're just hitting singles But when we really start to kind of roll out a little bit more of an expertise is that middle market space, which is, kind of 25 to 250 million in revenue. That might be, 15 to 25 units on the road. So you've got wheels involved. There's risk there. They're at that point, they're purchasing umbrellas. They need workers. They have workers' comp issues. And so we're kind of, manuscripting all of the markets. And it might not just be one carrier that wants to take that whole slice of risk. We're having to kind of divide that up with different classes of business on the carrier side. And it's a little bit of a rhythm, and I find that we're kind of quarterbacking that process. We're kind of like, again, watching carefully what the client cares about, but also just, making sure that marketplace kind of fits in with what the client's expectations are. But that size, is about there. That's our sweet spot. That's what we get excited about. And then above that, we're going to start running into the national brokers, like the big alphabet houses, the Aons, the Locktons, the Willis, Tower Watson, the Marshes of the world. So, that's their sandbox. Not that we can't compete in that sandbox. We have to have a really tight relationship with the client at that point. But that's just, at that scale, the client has different needs. They're going to have, a claim a day. They're going to need a lot more hand-holding on the carrier claims process side. We do that. We manage claims for our clients, but if you have that volume, we're just not going to be able to, keep up.
And insurance seems to be a business where the size of a client relationship is important, and everyone kind of has what their focus is. And so your focus is in this middle market, because that's where you guys can provide the biggest value to your clients, right?
Yeah. What happens is those national brokers I was just mentioning, they have their minimums, just like anybody has their minimums. So those minimums have been raised to, in some cases, $10,000 to $25,000 in minimum revenue to those brokers, which those are not walks or singles to us. Those are doubles and triples to us. Mm-hmm. So we've developed a business around that. And then those business owners, typically, again, it's important to define, there's going to be a founder, a sibling of the founder who's running that business. Yeah. And they are the sole decision maker. They're not going to have a lot of handlers around. They're not going to have, teams of attorneys and accountants and people who are making decisions. They have those teams, but everything leads to the guy or gal that's running the show. Once you go to that another level, now you're, having to roll out the red carpet in front of boards of directors. And again, I can handle myself, but I'm going to get beat because, those guys have a different pitch. They have a different, and it's just a different kind of rhythm to that. Mm-hmm. So when they have that owner or that founder who's they care deeply about that business, and it's the honeypot for their heirs and their family. So when it comes to risk, we become a partner for them. Whereas, again, now we're kind of talking about that lower amount of revenue or tier. They're not going to care as much, and there's not going to be as much risk depending upon the class of business they're in. And so what happens naturally is, you become friends with them, and then you meet their kids, and now you're having to, maybe the kid's got a heavy foot, and you got to take care of his auto insurance because he just got canceled by the big, Hartford. Hartford's like, we're not going to write your 16-year-old kid is speeding around town. So, then we get into the personal lines, and then that's how those relationships last. And I have relationships that have been in place for 15 plus years. And those are relationships that we care deeply about. So we're not in the churn business. We're not in the, just bind and crank and just keep running. We're really curating those opportunities as they come in and trying to say, hey, is this somebody that we can partner with and they want to partner with us? We do have in our business, we do have a personal lines department that does a little bit of that, kind of grinding, quotes. And, the expectation today in the technology world is like, hey, if that call comes in, they want a quote in 30 minutes, which is, I mean, that's stressful. I mean, that puts stress on me as the broker. That puts stress on our team as the team who's doing it, because there's 20 other people in line waiting for that too. So, you know, you really have to have a mindset if you're going to be in that business of volume. You got to be set up for that, because the client's been conditioned to think that, you know, this is easy and it's, you know, price is the ultimate decision maker of it.
And they're conditioned to that. And this is something that I've talked about on this podcast before, but they're conditioned to this because the giant, you know, companies, namely here Geico, right, has really said, you know, 15 minutes can save you 15% or more. And how many billions of dollars has Geico, you know, really spent, you know, just driving that message into every American consumer's head over and over again for what, I don't know, the past 20 years probably. So it seems to certainly be that is the expectation that personal lines consumers have, and it is stressful. You know, as you know, I own an independent agency, and I also used to be a captive agent with Allstate, as many people know. And you know, there's a big difference between quoting one product and price and quoting multiple, and which ones do you start with, and you know, the different rating platforms and the technology challenges of comparative raters and things like that.
Yeah, you know, I know enough about personal lines that, you know, when you're in that situation and you're trying to do the best for the client, and you're in what we call the gathering stage, you know, and you're like, the call comes in, hey, I got your name from my buddy, he knows you real well. Hey, I just want to get a quote. And, you know, immediately you're kind of like, I really don't want to quote this. You know, it's like, I want to do business with you.
Yeah.
So you're already kind of on guard. And then you're like, well, for us to really do our job correctly, we're going to need a copy of your homeowner's policy. We're going to need a copy of your auto policy. We're going to need to know all the named drivers in the home. And what other toys do you have? Do you have ATVs? Do you have motorcycles? Do you have boats? You know, we want to put all that together and then make a best-in-class decision for you and your family. Mm-hmm. And when you try to have that conversation 3, 4, 5 minutes in, the guy or gal's like, yo, I just want a quote.
Yeah.
You know, and you're like, man, I'm not trying to sell you anything. Yep. I'm trying to do the best for you. I know the insurance marketplace, and you're sitting there a la carting this, and you're getting creamed on price or terms.
Yep.
And if you just trusted somebody who can handle this is their business, we can go out and get you the best overall deal for you and your family. But you, the buyers, just, yo, I want my quote. You know, I think I'm the smartest guy in the room, and I'm going to make the best business decision for my family. And it's like, man, you got to let go of that and understand that we are the experts in the room when it comes to insurance buying, and we're going to give you that advice. We're going to help you make that business decision. And I think overwhelming majority of people don't approach the market that way. They just approach it like, I want a quote. I'm going to go get 5 quotes online. None of those are bindable, by the way. You know, you don't even know what they are.
Or what they cover, right, or what they don't cover.
Buyer beware kind of situation. And then, you know, they call their wife, hey, I just saved 20%. It's like, no, you didn't. You got smoked.
Exactly. Exactly. Otto, one of the things that I like most about our interactions when we see each other at conferences and such is I consider you to be like, you know, as big of an insurance nerd as I am. And, you know, that really is saying something. So, you know, we're in this place, you know, here in early 2024, where we're in a very high inflationary environment. We've seen a lot of insurers take rates, pretty substantial rates, especially in the personal lines world, as we've you know, kind of exited the pandemic. Where do you think the insurance marketplace is today? You know, my wheelhouse, my world is in personal lines insurance. Yours is more in commercial insurance. Have we seen these kind of really aggressive rate increases on the commercial side as well?
First of all, I think it's important to denote when we talk about, you know, insurance on a macro level. This is at 10,000 feet. So many things go through people's minds. But from a marketplace standpoint, you really have to define that out. And the news outlets and the blogs and the, you know, folks that kind of are just trying to get their name heard really don't do a very good job of explaining what that is. And so when somebody says rates are up, you kind of have to go a little bit further down. And you started that conversation, you know, commercial, but, you know, let me just help disabuse this a little bit. I mean, you know, workers' comp is a different marketplace than umbrella.
Yep.
And then when you think general liability, you might be running a temperature in the 5 boroughs of New York for a general contractor who's climbing up 30-story buildings versus, you know, a guy who's doing that in Clark County in Las Vegas. Those marketplaces are independent. They're similar. They're unique. They're similar, but they're very unique in their subsects, and that's because of states. Insurance is state regulated. Not a lot of people really give enough credit to the fact that insurance is regulated individually by 50 insurance commissioners on a state level. And those state statutes that govern how cases, outcomes in front of judges and courts are determined, and juries are determined in the court of law, will drive price up or down.
Yep.
So when you have a speakeasy in Alabama that's getting, you know, over serving young adults, and they're brought up for, you know, liquor liability, the laws in Alabama might think differently about that than in New York or in Tennessee. So the cost per unit of liquor liability is drastically different in each place. And so people don't process that. We're nerding out here, but the point is so commercial auto in New York is different than commercial auto in Ohio. You know.
So in Florida, let's say, where you specialize, have you seen in the commercial world? Let's go commercial auto, right?
Yeah.
Let's deep dive into this. Have you seen the type of aggressive rate? I mean, we've seen very aggressive rate action in personal lines auto across the country. Have you seen that over the past 2 years in commercial auto?
So I have. I think it's important to. I'm kind of a history guy, so I've been doing this a long time. I've seen the cost per unit as low as $1,500.
Yep.
And I've seen it trade at $12,000. So the spread on that over a 17, 18-year period is incredible, right? That will fluctuate up or down. Right now, I mean, we're seeing some mid-markets write some, you know, units depending upon the fleet size, but you can get deals done for, you know, $4,000 to $5,000 a unit. And then if you're tipping into, you know, anything where you're actually hauling things, you might see $35,000 to $50,000 a unit. Mm-hmm. So, you know, it gets crazy. And so you'll also see some very creative actors out there who are, you know, buying one policy from a captive to get that $1 million limit with that scheduled auto, so they can put that on a certificate, and then they're going and for the other 15 units they have, they're buying 10, 20 on the liability and saving, you know, 30% or whatever they want to think. So there's all these games that people play, and when we walk into that, we're just like, hey, what are we really doing here? I mean, you know, and that's kind of the conversation that we have is like, this is really your business for your family, you know, your livelihood, like you're really running a risk here. And if they can't have that conversation, we usually just disengage and walk away. But on a interesting kind of, you know, level of rates and how the inflationary world has run into insurance, yeah, it's important to understand that insurance companies run at about a 96 to 102 loss ratio, like that.
All right, and break that down. What does that mean?
Right. So that means that if they're taking $1 in premium, they're paying out 96 to $1.02. That is super thin margin. I mean, insurance is not a good business. Risk-bearing insurance is a mediocre to okay business. The only thing that, you know, kind of levers up the opportunity to make it a great business is if you know how to manage the money that's sitting there waiting for the claim to be paid. If you can create some alpha and actually get a above average return on that, it turns into a great business. The other reason why it's not a great business is because when you make money, the regulators say, you got to keep that money in your business. You can't take it out. So that frustrates a lot of the capital markets who want to, you know, kind of, you know, lever things up and get aggressive on, oh, let's start an insurance company and then make some money and then pull it out. No, the regulators are saying, no, you got to keep that in there for 7 years, you know, for the rating. So it's really tough.
And you have to deal with 50 state regulators.
That's right. You've got got all these different, you know, unique things. It's a highly regulated, very, very paperwork intensive business. I mean, you know, I want to sit here and say I'm this cool broker that is doing deals all the time. What do I really do? I'm playing with spreadsheets and PDFs all day is really what I'm doing. So it's pretty, and I'm on the phone a ton. So.
Well, and this is a great segue into a product that I think many of our clients and many of our listeners and viewers will want to get into, and that's what's written here on your shirt, right? Which is TCPA.
The cheesy plug, yeah. I got to throw the flag out somewhere. This is it.
And this is one of the things we talked about when we first met, and I didn't know such a product even existed at the time, but you know, I think all of our listeners are very familiar with the Telephone Consumer Protection Act, the changes that the FCC has voted on and made effective for early next year, primarily one-to-one consent as being the requirement going forward, and not having, you know, multi-client consent, as I would call it, where we're gathering consent for, you know, hundreds, thousands, or dozens of entities. But so TCPA is a huge issue in the lead generation space. It's a huge issue for the insurance agents that we serve and we sell leads to. We're very compliance focused. We're very mindful of the rules and regulation. But I always break it down to this, right? We're mindful of being respectful to the consumer, right? And you know, I always try and put myself in the place of a consumer. And when I talk to the insurance agents we work with, we talk about call cadence and, all right, how many times are you calling? And like literally, I had one prospective client tell me that his practice is to call 9 times on day 1 and then like 12 times on day 2. And I'm like, oh my God, like that's crazy. If someone called me 9 times in one day, there's no chance I'd ever do business with that person. So we're mindful of the consumer experience. As we've talked about many times before, right? We're one of the founding members of REACH, Responsible Enterprises Against Consumer Harassment. Yeah. You know, our mutual friend, Eric Troutman and Troutman Amin law firm. Yeah. And those guys are great. And they do an excellent job defending these class action claims that you know,
well, they also help people understand the compliance side as well. So that's huge too.
And that's a huge portion of what we're trying to do here. So tell us, you know, I think there's risk, and you know, I was having dinner last night with one of our clients who told me that prior to them being one of our clients, they had settled a TCPA lawsuit. I've had TCPA demand letters before come. You know, this is an important area for our clients to understand. So tell us a little bit about, you know, your experience with that, your understanding of it, and how we can offload that risk for a premium, right, to someone else and have them, you know, deal with that. God forbid that
manila envelope from Dewey, Cheatham and Howe shows up.
Exactly right.
Yeah. So I've actually been brokering this for a while, probably about 10 years, and you know, I stumbled upon it because, you know, somebody called me on a big account and they're like, hey, we need this very specific type of language in this policy. And I was like, yeah, we can do that. And then I hung up the phone. I was like, oh my God, who am I going to get to do this? You know, it was kind of a classic sales story. But, you know, short story long, I made 100 phone calls, found somebody that could do it. You know, I pitched the risk the correct way, and you know, they ate it up and threw a premium on that, and we did the deal, and it was a great thing. And then my whole world changed because I saw the regulatory risk, and I saw that nobody understood the insurance piece of it. Nobody was actually, you know, helping people manage that little piece of their balance sheet where there's some exposure. And so I was like, all right, so I did 2 things. I tried to develop the marketplace. So I was constantly talking to new carriers and saying, hey, this is the risk, this is the premium, and could you do this? Is this something that you could kind of take a bite of? And an overwhelming majority of carriers are like, you're crazy, I'm not touching that. Now we got a couple, you know, entrepreneurial underwriters that are, you know, a little crazy, and they, not crazy, but they're just, they beat to their own, you know, drum. They don't have an underwriting manager over them saying, hey, what was your loss ratio today? They look at it like a 5-year loss pick, and it's a different business model for them. So they can take bigger chunks of risk, and they're going to take a little bit more pound of flesh for that. So I kind of started to develop that. And then I started to kind of try to find more buyers of this and explaining what the risk was. I think the fact that some people are making phone calls and there's this, big, now again, going back to state and federal, this is a federal law. This is not a state law. This is a federal issue. Now we've had some states make their own individual laws so it's kind of doubling down on the risk in terms of how you're calling and what kind of text messages you're sending out. So I kind of saw all this, and I'm kind of like, man, there's a market here. I think I can build a business on this. So I just kept cranking. 1 turned into 2, two turned into 4, and then I just kind of had this like ramp explosion where I just kept at it. Good things happen to good people, and now I'm like I said, I'm 10 years in, and basically I'll get 2 or 3 calls a week on this, or it could be like, hey, I have a contract from Select Quote that is demanding this specific coverage, and I'm like, yeah, we talk with them all the time. We'll get this done right now. That's kind of the, we have the manufacturing line for that set up, and that's like a 3-day turnaround to get that deal done. That's kind of like, we're ready to go right now. We just need to sign with Select Quote or whoever. I don't want to name names, but the world of that contractual obligation for this specific coverage, and then the kind of the opposite side of that would be like, hey, I got your name from so and just help me understand what this is. I'm very skeptical. How is this possible? Yeah. So you kind of have to walk through that, and luckily I've been doing it long enough where I can boil that 100-page contract down to a couple minutes of like, hey man, there's a promise to pay when things go wrong. They're going to hire an attorney, and basically you can offload this risk to an insurance company. If you value your time and the reduction of risk, it's good allocation of capital for you. Yeah. If you don't value your time and you really don't care about the risk, then this is not something that you really care deeply about, and you're probably going to go, run amok of what you're doing in your world. So it's taken me a while, but I definitely have gotten a lot better at kind of sizing up opportunities as they come in, and it's really fun because this space is filled with entrepreneurs and all kinds of people, people that used to be in a business and now they're transitioning into some kind of lead gen, and whether it's insurance or mortgages or home services, or so you get to see a lot, you get to talk to a lot of cool people,
different people in this business.
So it's interesting, but from a TCPA standpoint, I don't see many. I think today maybe some people are doing it more, mostly because they just kind of a blind squirrel finding a nut every now and again. Not like they're specializing in it like we are. But now,
so you would consider this one of your specialties.
Oh, this is one of your specializations. Absolutely, this is a specialization.
You're here at LeadsCon and at Medicarians to meet prospective clients.
To meet people. I'm really here to educate them to say, hey, this is available. Yeah. Because I don't need to sell anything. Stuff sells itself. Like, hey, if you're going to buy, you're going to buy. If you're not going to buy, that's fine too. I'll talk to you. I'll give you some time, but I'm not going to lose any sleep. Like, I just want to educate people and say, hey, this is available. And so,
because most people aren't aware.
They don't even know.
They're not even aware this is.
I cannot tell you.
As someone who's a self-defined insurance nerd, I did not know this product existed.
I can't even tell you how many times the phone's like, or they're like, hey, I got your name. And I'm like, yeah, what's up? They're like, you're not real, are you? Like, this is fake. This is not, I'm like, they're like, oh, this must be from like Shifting Sands Mutual, some crappy insurance company from, Wyoming that, it's like a couple of guys in a cabin with, and I'm like, no, this is $1 billion insurance companies. This is as real as it gets. And, contract in America still sticks. So we're here to actively protect your business, and we can do that. And so people they're starting to get it. I think the contractual obligation will really drive, will drive the market in a different way. I mean, if you want to build a house, a county or a state official is going to say, hey, your general contractor has to have this amount of coverage.
Sure.
You want to buy a house, the bank's going to require coverage. You want to do, a landlord, if you're renting, they're going to have required coverage. The internet, for whatever reason, is just kind of lagged on, kind of coverage requirements when you get in those contractual obligations. And I think it's just lack of understanding of what the risks are. I mean, you'll see contracts with folks in internet-based businesses where they're still asking for general liability. General liability pays for bodily injury or property damage.
Yep.
You're in cyberspace.
Yep.
Where's the BI or PD?
Yep.
So that helps kind of helps people understand that there's a lot of people that are still just doing the same thing without actually thinking about what the risks really are.
And I wasn't planning to go down this road at all, but I think it's a good road for us to touch down for a second, because you just said the word cyber, right? And I think that many of the business owners that I work with on a regular basis don't have a proper understanding of the risk that their business is exposed to with cyber risk. And I think that's been a huge uptick in the insurance market for probably about the past 5 or 10 years. We've seen places, like we mentioned earlier, we're in Las Vegas, right? I think maybe it was about a year ago at this time,
That's
maybe
right.
less, but I feel like it was when I was here for LeadsCon or close to it, that there was cyber terrorism here at some of the largest casinos, and resorts in Nevada. And, these are huge exposures. And as insurance agents that are our primary customers, right, they're dealing with an immense amount of personal information of their customers. And what are you recommending folks do besides just buy cyber insurance? What can they do to properly protect themselves? And what percentage of your small, your middle market businesses are getting cyber coverage? And do you think that that's on the increase, or just tell us a little bit about that?
Yeah, I would say, 10,000 feet, cyber, I guess this is something I've said a couple times, but, if you look at a fire rate in our business, we have actuarial data going back to 1800s, and we can kind of dial in what that cost per 100 should be based on where you are on the geographical map. And they basically have gotten that down where it's like, we're going to make a profit at X amount. We have this kind of aggregation. Cyber's the new wave. Like, they don't even know what the claims are. They don't even know what the risks really are. Insurance companies move like battleships. They don't move quickly like the internet does. The internet is super nimble, and insurance companies are like, whoa, slow down. Like 10 years is like, in insurance company years is like a year.
Yep.
So, and that's basically, like you said, the cyber market, has really been developed in the past 10 to 15 years. So that's like white space, which is very unique in insurance. And when you think about going back to kind of actuarial data statistics, like, your business today is statistically more likely to have a cyber event than to have a fire. Yeah. So it's like everyone buys fire insurance, and yet you have a higher likelihood that you're going to have a cyber event, and you don't even know that you can offload that risk or buy that insurance. So yeah, I mean, the good news is it's cheap, it's inexpensive. So you can buy a policy in that world from anybody. Really things to consider are, read your agreements with your cloud, companies, because, you're like, oh yeah, I got no liability, it's with the cloud. Oh yeah? Yeah, sorry.
Probably not true.
Read that agreement. It's going to tell you that, they take no liability for, their systems getting breached. And if anything happens, it's your data, not ours. And so it's just, again, you really have to, understand what you're getting into. And like I said, the good news is it's fairly inexpensive for, a startup business or even a small business, a couple $1,000, you can get $1 million limit. And so, yeah, I mean, and then the second component that just from a claims perspective that we're seeing a ton is this cybercrime social engineering, which is, let's say I'm traveling in Las Vegas and, somebody has hacked my email and they're just watching my email. And they see that I get a travel notification from American Airlines that says, hey, your your trip is coming up. And then, you know, I see check in at the Wynn Hotel. Oh, hey, great to have you at the Wynn, you know, checking in on Sunday. And then this, you know, hacker is watching this, and then they'll see that this is the opportunity. They'll, you know, kind of spoof some call to accounting and, you know, my office and say, hey, the Wynn needs an advance payment of X, and, you know, Otto's, you know, unavoidably detained, and maybe the accounting person in the business is, it's like, oh, I got to take care of this, and boom, they send the wire, and what do you know? Like that
money's gone.
That's gone, and that's happening with payroll companies. You know, there's just tons of things that are happening, and really from a compliance standpoint, that's where the time needs to be spent. It needs to be spent on email phishing, you know, understanding that social engineering risks. The key is, in my professional experience, is just slow down. You know, slow down and get double confirmed. Get, you know, hey, thank you for calling, you know, but I need to double confirm this, and, you know, send, you know, the text is, I think we're all inundated with new, you know, multi-factor authentication, and it's annoying, and it's not fast, and I know it's frustrating, but, you know, again, it's for our protection. And I had a bad attitude about it in the beginning because I'm like, this is annoying. Now I'm like, all right, you know, there's reasons for this, and it's smart, and it's only going to get more complicated. It's not going to get simpler. So,
and you know, speaking of that, last week we actually received you know, an email impersonating one of our employees asking us to change their banking info for their paycheck. You know, upon confirmation, slow down, get the confirmation from the employee who was traveling out of town. Coincidentally, was far away in Hawaii, different time zone, different. You know, it was like, slow down. We took that exact approach. Like, all right, if this week's payroll goes into his existing bank account, who cares? And upon confirmation, it was not that person who even sent the information. So, and this is happening to, you know, I mean, we're certainly not a Fortune 100 enterprise, right?
I think the target is the small to, you know, medium-sized business. I think that's where the vulnerabilities are. You know, I'm gonna pick on, you know, Diana in accounting, but, you know, she's sitting there like, oh, hey, you know, oh, sure, I'll take care of Hillary's change, no problem. You know, it's like, man, you know, that's where the opportunities are, and it's so the point is you can actually reduce that risk. I think the best course of action in any transaction is not to buy insurance at all. You know, in the world of insurance, there's two reasons to buy insurance. It doesn't matter if it's homeowners, property, you know, auto, life insurance. It's to insure against events that you're unwilling or unable to sustain yourself. And that's an important understanding. You know, a lot of people buy insurance they don't need, and then a lot of people don't buy enough of the stuff they do need. But you know, that unwilling or unable, and then the second is when the insurance marketplace gives you a price that's too good to be true, and you just load up. And those are the really, you know, got that from the OG, the Warren Buffett. You know, that's his quote. But you definitely got a footnote, the OG, Mr. Buffett. But he's taught me that, and it's paid dividends forever. Like I don't walk into a situation and say, hey, how do we reduce risk by buying insurance? That's the last thing we want to do. You know, like the last, it's like, hey, if we can solve this with, you know, saying, hey, my 16-year-old is not allowed to, you know, drive a car, well, we don't need to buy insurance for them. That's smart. That's a good allocation of capital. If we can tie up some kind of compliance issue and really dial it down, we don't need to worry about the risk of that. Risk exists when you don't know what you're doing. You know, when you are treading into areas that you are unfamiliar, you know, back roads, you know, back to your kind of, you know, auto insurance rating, like, you know, when you stay local, your rate's cheap. Once you go beyond local to intermediate or long distance, it gets more expensive. Why? Because you don't know those roads that well. And that's statistically, actuarially sound underwriting. When you know, so a long distance, you know, it's going to be a higher rate. So when you don't know where you are, you're treading in unfamiliar territory, the risks just go up. And a lot of people are not alert to that. They're not, their antenna's not up. They're just, kind of drifting around, maybe in a place that they shouldn't, and then they get smoked by, some attorney or some kind of issue or problem that pops up. And, that's when people need insurance or things like that. But it's really important. There's a guy a guy who started an insurance company. It's a very interesting insurance company. They took on the highest risks in the world, and he's this total cowboy. His name's Rick Lindsay. He's very, very Googleable, very much a podcast, YouTube superstar, and he'll kind of talk about this stuff like when there is a claim, the business owner, the homeowner, whatever, they're immediately calling and saying, "How much are you going to pay? What's going on here?" And his attitude, and he's taught me a lot too, is like, slow down. What would we do if we didn't have insurance? Mm-hmm. What would we do? How would we solve for this? Yeah. Well, the good thing to do is to call the person who's in the hospital and say, "Hey, is there anything we can do to make sure you're okay? We want to take care of your medical bill." That's the right thing to do. Yeah. Now, your attorney, your legal representative, don't reach out to them. You're just asking, no, that's, it's like, what would you do if you didn't have insurance? Yeah. Now, it's a difficult kind of thing to start a conversation that way, but once you get there, really kind of frees up the opportunity to go, wow, let's just do the right thing. And
it's always value in that.
Yeah, it's just sometimes simpler is better. Less complicated is better, but it's a mindset, and there's just lots of lessons to, being a good business owner, being a good person of character in business, and when you're running an insurance agency or interacting with clients, you're going to pick up on that. You're going to pick up on, is this person like sketchy? Like, are they like trying to game the system here? Like, you can hear it. You can kind of see that little sparkle in the eye go off. They're like, oh, this is opportunity. It's like, at that point, this is a different transaction. So sometimes you have to turn clients away. But yeah, it's as an insurance agent, it's a great thing to be able to see all that. And I've found that it's made me a better person because I've been able to see how people are and just interact with them. And it's just been a great joy. But the opportunities when you are a insurance agent in the space to grow, whether it's cyber, TCPA, auto insurance, it's really just about that interaction and developing that personal relationship. We focus on that a lot. The personal relationship is super important for us. Something that's super important.
Getting back to the TCPA insurance quickly, and I just want to end here. I think there's a great value in this product for our clients to have, even if it's let's just call it a nuisance claim that comes in where all the right things were done, but whether it was, someone set you up or someone forgot that they filled out a form or, anything like that, I think that there's value in having this product so you can at least sleep easy at night. How simple is this product to acquire from your perspective? What should, just give us a little buying advice from folks. What information should they have readily available when they reach out to you to talk about this?
Yeah, and if your brother-in-law is an independent agent, call them. I mean, you don't have to call me, or I hope they can find it. But if they can't, call me and I'll help. But the point is kind of new to my product development with some partner carriers that we've been able to work with specifically for insurance agents. The rub has always been, well, it's an E&O product with a TCPA endorsement officially. And so, insurance agents are kind of unique animal in their own, and they have their own marketplace where there are these different programs, and a lot of the captive agencies kind of control those programs. So exactly. It's tough to kind of break in. So I've been really pounding my carrier partners like, hey, I need something to help supplement this because there's a lot of need. We got a lot of flow here. So we've been able to kind of create a monoline TCPA product for those that can't leave or don't want to leave that great deal they already have on the E&O piece, and they can just kind of dovetail this monoline TCPA piece to that. So, and that's a minimum premium type thing to $7,000 to $10,000 in premium. A lot of money. I'm not sitting here saying that's not a lot of money. But you are able to reduce that risk to zero. And I really care deeply about saying that, because, you know, the way the policy is written, it says we will pay to indemnify you in the event of a claim where you're found legally liable for breaking the TCPA law. I mean, it's clear as day. I mean, you know, so yeah, it's something that I'm super excited to share with the community, the insurance community, because that's been a huge issue with leaving that kind of great program, because it is great. They've got a big, you know, it's a long-standing relationship with the carriers. It's kind of plug and play. You know, it's really just set and forget. They really don't have to do a lot. And it's really just an application process, understanding what revenues are, and want to know a little bit about compliance, and it's a couple pages of applications, and then you send it to the market and get some terms. But that's the basic process.
Awesome. Otto, thanks for joining us on the podcast. Appreciate, you know, your advice and the lessons and the wisdom you've shared with us and our.
It's my pleasure. You know, you become a friend, and I really appreciate the relationship we have, and it's just fun. You know, at this point in our lives, we're lucky enough to we want to work with people we like and have fun. So
exactly.
So thanks again.
Thank you.
To see you.
Thanks everyone for tuning in to this episode of the Lead Clinic podcast. We hope to see you again soon.